Very good evening to you all, and welcome to this special edition of ForFarmers webinar, where we'll be focusing on the economics of organic milk production. We're very lucky to be joined this evening by George Harvey and Andy King. A bit of introduction for both of them. George's family are dairy farmers in Hampshire, and George graduated from the Royal Agricultural University in 2013. He initially worked for Safitra as a farm trader, and had a brief spell trading currency in London before moving to Gemcom as a commodity trader. George will be giving us an overview this evening on the current situation and challenges with organic raw material supply. Andy is a graduate of Seal Hayne and initially spent 15 years in animal feed supply and nutritional support on farm in the ruminant sector with both BOCM Silcock and then BOCM Pauls. From 2001, he worked for a large dairy farming and milk processing business in Somerset, where he set up the first dedicated organic producer pool, supplying a major UK retailer. In 2020, he set up Barrington Consultancy Partnership. This business offers advice to supply chain stakeholders and specifically farmer producers. The advice on farm is heavily geared around dairy nutrition and economics, set within the backdrop of customer requirements and expectations. He's also been dairy farming in partnership with his wife Rosemary since 2008, where they keep a herd of 250 organic Holstein Friesian cows. And he's going to look at economics and efficiencies of feeding cows in organic systems and comparing year-on-year margin effects. After the presentations, we'll wrap up with Andy, George and myself available to try and answer any questions asked. There is a chat box function, which is the question mark in the top right-hand corner of the screen. Please feel free to submit any questions in there. My colleague Cara Green will kindly monitor and forward the questions on to me to try and make sure all runs smoothly. So without further ado, I'll hand over to you, George.
Thank you for having me, Ben, and a pleasure to be here. I will be presenting the organic commodity markets in three sections: historical, current and future. This will hopefully take around 15 minutes, and like Ben said, I think all questions are at the end. We will start with some historic pricing. The two below charts show prices since early 2018 for organic soya expeller and organic rape expeller. You will see rough delivered UK price along the y-axis and specific delivery periods along the x. Price for both expellers has experienced a steady uptrend, but the real momentum kicked off in 2020, as you can see from the charts. Soy has moved from £510 a tonne to £1,100 a tonne today, with a high of £1,250 a tonne a few months ago. This is a £590 a tonne increase, a whopping 114% from the low, and one of the largest increases in such a short amount of time I've seen. Rapeseed expeller has jumped from £425 to £780 a tonne and is trading at a historical high today. That represents an increase of £355 a tonne for rape expeller and a 79% increase. There are a few reasons for these long-term movements. The first is container freight from China. In late 2020, we were paying about $4,000 a container to move from China to a UK port, but a year later that jumped to about $15,000 a box. This large jump was fueled by demand for consumer goods from China due to lockdown. Because of these higher container costs, shipments moved to break bulk, which proved to be a lot more competitive, but it still wasn't enough to ease prices. The second major factor is pound dollar. Early 2018, pound dollar was at 141. and it is actually trading at around 123 this afternoon. This is a 13% drop, and to put it in real money, if you use a commodity priced at £910 a tonne, it represents an increase of £103 a tonne just in currency. And then you can see the last aggressive moves on those charts in March, which doesn't need much explaining. You throw in higher cost of productions, inputs, global congestion, freight rates, and it's been a pretty perfect storm for organic commodities. Next two charts, please, Ben. The next two charts are organic wheat and organic maize. Organic wheat has jumped from £3.15 a tonne to £5.20, an increase of £205 a tonne, 61%. And again, is trading at historic highs. Organic maize has lifted from £2.98 a tonne to £5.10, an increase of £212 a tonne and 58%. Again, historic highs. Like the expellers, grain started showing serious bullish intent early 2021. The conventional market moved to the upside so aggressively and in a short space of time that organic producers in Eastern Europe and the Black Sea were selling their grain as conventional. With such a rapid market move, that the grain had made its margin, conventional or organic. So plenty of them chose not to take an organic risk and just sold it as conventional in the end, which led to a massive lack of offers, or a lot less than we were expecting anyway. There is a tiny bit of good news, historical good news for the grains, which is pound euro. Plenty are bought in euros for import to the UK. Rates went from 114 to 117 today, but it's only a small gain of about 5% and a drop in the ocean, really. Like the expellers, freight and congestion have played large factors. Again, to put it in real money, bulk coaster freight from the Black Sea doubled at its peak a few months ago. It went from €40 a tonne 18 months ago to €80 a tonne a few months ago. Next slide, please, Ben. This is just summarising what we've been speaking about, but actually those currency prices are wrong now because the pound's taken such a hit today. And again on the grain, the Russian invasion needs little explaining. Next slide, please, Ben. Oh, sorry, just in conclusion, the main reasons for current prices are conventional markets rising, shipping congestion, currency, and war. War being probably the most influential there. Section 2, we'll look at current markets and what's affecting them. Firstly, interest rates, which is extremely topical, as the Bank of England raised rates from 0.5% to 1% today. And over the past 10 years, interest rates have paid a small cost in trading and borrowing money for anyone, basically. But this looks like it's likely to change. Inflation at 7% means that everyone is bullish towards interest rate rises, and these will have to be priced into trading and I presume farmers buying as well. The last time we saw inflation like this was in 1992, and the interest rate was at 10% back then. So we think we're heading in the same direction. Next slide, please, Ben. This shows the shipping congestion in China at the moment. The right-hand side shows a few ports on the east coast of China, and you can see each coloured dot there represents a vessel. The one on the left is zoomed in on Tianjin port. This is an average sized port for China anyway. It exports plenty of ag commodities globally. And those three circles on it show vessels in a queue waiting to load. And if you were to zoom a bit further in on those, which I did earlier, the smallest red circle at the top shows 70 vessels waiting to load, which is congestion we've never seen, and I don't think the world has seen for a long time. The third factor at the moment of affecting prices is the war. Next slide, please, Ben. This diagram shows in the darkest green the 6 largest grain producing states in Ukraine, and the shaded red area shows where fighting is the most intense at the moment. But if you were to go hundreds of miles west, there is still heavy shelling and fighting, and with the Russians deliberately targeting infrastructure now due to Western weapons, it will be extremely hard to move grain there, if not impossible. I mentioned currency earlier. We took another pasting today on the pound, mainly from the dollar. The Fed's hawkish stance towards interest rates is a lot more aggressive than the UK's, and that's being priced into the FX market at the moment. But having said that, the pound is holding up fairly well against the euro. So that's something to cling on to for the moment. The final thing which is having a large effect on the current market is lack of demand in the organic world. This feels like it's coming from general worry inside the organic market, as the whole market weighs up how much demand will be left after all the price increases. But that's a slightly double-edged sword, as if there is a load of demand to come into the market, it'll push things up again. But the lack of demand, I'd say, has stalled the rally for the moment, we'll say. Next slide, please, Ben. The last section is what we might see in the future, expect to see, and it's definitely the hardest section. We're yet to see Ukraine export grain in any large way at all. In fact, I think grain exports are dwindling, and the chances of them being able to export any organic grain seem extremely far-fetched at the moment. As just mentioned, the state of the organic market will be a large factor for the future, and how price sensitive consumers are. There are people who peg price sensitive organic consumers at around 25 to 35% of the market, but I don't think we've seen aggressive price rises like this before, so that figure might need revising. We've got the UK harvest to look at, and although we have had some rain this week, there's little in the forecast. But having said that, unless something drastic happens, we'll still look average or above average. And the other big factor will be EU harvest. They've had more rain than us, wetter conditions, so that looks well above average, which is good news. The final thing to speak about is something on a much larger macro scale, and many believe we are in the 3rd or 4th year of a global commodity super cycle. And by way of explanation, commodity super cycles are a relatively rare phenomenon where commodities trade above their long-term price trend over a long period. Only 4 commodity super cycles have been identified since the 19th century, each tied to a transformational period of economic development. The last one characterized the first years of the millennium, and it was fueled by the rapid industrialization and economic growth of China and other emerging markets. I wanted to end on something slightly less doom and gloom, maybe. And it's important to get a balanced view, really. So there are some quotes which should give people some hope. And everyone found this insightful. I look forward to answering questions at the end. And thanks again for having me, Ben.
Thank you very much, George. Andy.
Okay. Thank you. Well, first of all, thank you, Ben, for inviting me to speak. I mean, 20 minutes or so on organic economics at farm level. Well, what a gig! That's all I can say. It's been a bit of a ride at the moment, and I think we need to dig deep and look forward and think where we're going. But really, the plot spoiler says that whilst we're facing a lot of strong headwinds, the economic efficiencies out there for the best and the top, dairy farms will always prevail, and we will get through it. But it sometimes seems very, very challenging at the moment. So the talk is really in 2 parts, and I think the talk is coming on the back of quite a kind spring up to now, based on the fact that I call it, we've had a bit of a winter of discontent in terms of cow performance on farm, with milk volumes being up to 9% down on last year. So we've got a bit of a rebalance in terms of milk volume, which could help the value of that milk. So if you want to roll the slide on, please. And this is just to say, let's think about the influences on the market, where our products go, and what might be asked of us. So we've got supermarkets looking at 75% share into the consumer. Own label, supermarket label is dominant, but there's some strong brands out there that are growing and adding strength to our product. We've always had an issue with milk balance around turnout, but overall, taken across the whole year, the milk balance is reasonably, supply and demand is reasonably there, and hopefully, as time goes on, it won't cause an additional pressure point in terms of economics. There's always an effect on products split in terms of where our value comes from in terms of finished product, and we know that the retailers are trying to keep food inflation down. So we understand that that's going to be quite a challenge. How much of that comes down the line to us in terms of value or pressure, time will tell. But up to the last sort of 6 months, the market for organic dairy has grown ahead of conventional milk. With the economic downturn and the credit and the monetary pressures, we're not quite sure how much will be taken off back to the levels of 2009, 2010. But I think some lessons were learned then was if you take products off the shelf, people don't tend to buy them. So I think that the supermarkets are very competitive. They want to promote, and they want volume, and they need that for their market share. So a couple of sort of things. Exports have been disrupted since the early days of Brexit or pre-Brexit in terms of milk going abroad to take the balance off. But opportunities are arising for some of the major processors in terms of product. And it's worth mentioning there's an awful lot of ex-farm retail sales, small volume, but adding value and getting the name out there. to direct to consumer on farm. So that's the sales point of view, the output point of view. And the big question which we'll talk about through the chat is the agri-inflation, what it's meaning to our business, and looking at costs and looking at how those are proportioned through our accounts, if you like. So that's the backdrop really, and influences. So if we could go next. And two parts of the presentation, really just a very generic run through on looking at costings, profit model, whatever you like, how you like to explain it, and just looking at some of the focus areas and some of the things we discuss on farm when we're looking at full economic effects in terms of dairy. And there is a bit in the middle about can we retain 15% of our value for the business. Now that was something that up until a couple of years ago, top 10 or 15% of organic producers regularly did, but that's becoming more of a challenge, and let's look at what we might have to do there. And again, looking at moving on from the cost side of it and what we might end up with into what we drive. Because one of the things that I've always said to a lot of clients I see is unless we get the herd margin right, the gross margin from the herd, we can't run the business on saving money on the paper clips. We've got to get the real heart and the engine of the herd right to start with, and then we're not going to save our way out of this situation. We've got to get better performance, and we've got to look at economies and efficiencies in particular. So the second part is really looking at the margin side and the inputs and outputs in terms of yield and cost of getting that yield. So if we kick off on the next one, please. I know it's a really simple one, but I always think start very easy, and I always think this is where we should be on farm. You end up with your set of accounts, you give it to your accountant, and they come out looking totally different to what you're trying to run with on a management basis. But basically, we've got our income, which we're trying to maximise, and our costs, which we're trying to minimise, and whatever that outcome and that balance is, that's our profit line. And how do we maximise income or optimise income without buying those marginal litres at the top end? And how do we minimise costs or maximise the invested money we've got in producing milk without cutting the last bit that ends up in a bit of a catastrophe because income is severely challenged? And one way of looking at that is every year we would look at the key influences. So we concentrate on the key lines that we can do something about, and those that play a significant role in the farm accounts. So that's a sort of simple intro. If you go to the next one, we say the question I would sort of bring up with clients is what profit is needed? How much profit do you need? And I know it's as much as possible, possibly, or whatever, but it's knowing the requirements, because once we've crossed the line and we've got the surplus from the accounts, we need the minimum amount of profits need to cover long-term loans, capital repayments, possible drawings if you're in that sort of sole trading partnership type business, dividends if you're in a limited company, you've got shareholders, and beyond that we need more of a surplus to think about the investment on the farming business for the long term. So we've got an obligation to cover off long-term money, and then we need sort of confidence as well as the surplus to look at the long-term investment on the farm to keep things going forward. So how much profit is a real interesting question, and quite a deep question for people, personal question, because every farm is very different. So the next one, please. And really, the next two slides just look at influences on income, influences on expenditure, And really we look at the income of the dairy enterprise, and I sort of focus on the dairy enterprise rather than the whole mixture or the whole farm tonight. And the dairy enterprise, we're saying what do we look at the main components that drive the value or drive the income of the various parts. So milk is volume and value, pence per litre, as well as how many litres. Calf income is value of the animals and the type that are sold. Cull cows are numbers, but you don't necessarily want to just generate large numbers because you have an influence then on replacement costs. So it's a balance really, but the number of cull cows is reasonably significant on some farms. And then livestock sales, whether you do or whether you don't have a surplus of stock to sell on that side. And then there are secondary influences which still add to the value and can be quite influential, such as if you're talking about the milk, the constituents, the specification, seasonality, all going towards your top line. So you've got primary components and secondary components which look at how much your income value is going to be. And in all cases, if we look at economics and cost of production, we take out any form of farm support, basic farm payment or other farm support, stewardship, etc. So we focus absolutely on the enterprise, and then what we do in terms of farm support is outside the scope usually, and then you can add that in if you want to right at the end, but it's purely down to the enterprise. So okay, the next one please. So how we try and split it down quite simply is I look at variable costs, labour, power, machinery, miscellaneous overheads, and rent and finance. And the key cost centres really of those, feed, vet and med, bedding, forage, and parlour, and then the labour costs usually if we're PAYE, and then power, machinery, and overheads. They're quite sort of split. And there's an even distribution amongst which we'll see in a minute, amongst the costing headlines there. But on the far right of the screen, the calculated, there are on all these cost centres, there are things that we calculate in, and it's important to value them and to add them in. So we've got herd replacement cost, which is a combination of the value of the animals coming in and the cost of the animals that you're losing from the herd. So you get a net position, and that can be quite a significant difference on farm to farm. Own labour, how do you value that? We must value our labour. We've got to put a value in for that, because we have to pay, we've got to pay our staff, so why shouldn't we pay ourselves? Machinery depreciation and building depreciation is a sign of how invested the farm is and what the farm can do to invest. And then imputed rent, which is very often for those farmers that are owner occupiers, it's looking at the value of that land in terms of rental. So there's different aspects going into the different cost lines that we need to consider. The next one, please. And this was a quick slide to say, how could we, if we get in the top 10%, could we end up with retaining 15%? So I look at this by saying, if we amalgamated our inputs, our value, so our value of our income to 100 or 100%, what are these values of our costs against our value of our income? And these were sort of target areas to say our variable costs, could we keep them below 40% of our total value? Our labour costs at 15, power machinery at 15, overhead, miscellaneous overheads and admin at 5, and rent and finance at 10. And if we can keep those at, that means we got a 15% over excess that is there for the business and the profitability. Now, as I said, up until a couple of years ago, that was quite an achievable situation by the top 10 or 15%. of producers, and now that's becoming more challenging. So is it still relevant? Is it still achievable? I think we've got to push on to that. What I've just done as an example, if our value of output was 45p, you know, milk and animal costs and etc. Our income, then that was the breakdown. So we end up with a retained 6.75 pence for every litre of milk we produce. So that's a challenge. That could be quite a challenge at this current time. So the next one, please. So just looking at the how can we drill down what we think might be happening. So coming out of last year, 2021, we were looking at sort of about just under 40 pence, 39 pence a litre cost of production for various sets of data. And if we look at the possible rises that we've seen and project them forward, absolutely crystal ball. I wouldn't say these go through the whole of the winter period, but certainly into the winter period. We're looking at a new world of in excess of 47, nearly 48 pence a litre, and overall it's seeing costs going up by about 8.5 to 9p. So it's showing that we haven't seen changes like this. We've been doing cost of production exercises since probably 2009, and these are certainly the most significant changes and moves that we've seen over that time. So the next one, please. We just picked out two areas of what I think is quite a critical bit this year, whether we can or can't do things about it, but we need to just to recognise it. And once you've recognised it, then you might be able to think what's our target, what's our focus area should be. So I've looked at out of the ones before, the variable costs and the power and machinery costs, breaking those down into the different parts, the different cost lines that we allocate to them. And you can see under variable costs, dry feed, minerals is the dominant factor in that area. And if you look at power and machinery, the contracted costs is the dominant area, and the other, repairs, fuel, depreciation, is fairly evenly spread, although depreciation will vary from farm to farm. But we've got areas that we can do things with, and we can't, areas that we won't be able to do things with. But perhaps this is where we need to go beyond looking at the pure costs and saying what do we actually do to how do we operate in a different way to mitigate rather than just change from stop. And I've just two comments about this. These two areas represent about 60–65% of the cost of production for a litre of milk, so they're quite a focused area in themselves. And the question about stop the gaps was under the variable costs. There is a heading that says replacement costs, which can be again up to 15% of the variable costs. Replacements can be as low as 1.5 to 2p a litre, and can be up to 5 pence a litre if herds need that replacement churn and a large number of animals coming in. So it's all about focus and breakdown and seeing what you can do in those specific lines of on the ledger. So the next one, please. So this is the second part, really, and the second part is that having acknowledged sort of, right, we've got the costs, we've got the breakdown, we're looking at things are moving very rapidly and very significantly. Let's have a look at where we sit as a group, as an industry of organic producers. So we've got an average sitting somewhere 6,600, 6,800 litres. We've got a top quartile of 7,500 litres and above, and a bottom quartile of just under 5,000 litres. So like everything, we've got a distribution of output and value, and therefore we look at the cost associated with those different levels of output. That's how we would consider where we sort of go next. So the next one, please. I've just taken, this is Kingsay data from annual data to January 2022, organic herds only, and looking at Kingsay averages, and then looking at splitting it up into the top quartile, middle and bottom quartile in terms of yield. So if we can see, that follows what we've seen on the previous slide, an average of 6,900 litres, 3,500 from forage, just under, given a herd margin of 469,000. And it's just to make the point, if you've got the same number of cows and you moved into the top quartile or the bottom quartile, it's looking at what that herd value is based on the Kingsay numbers. So as a farm, you start off with 469,000 to move down below the margin over concentrate line. If you were high yielding with those herds, you've got 584,000 herd margin over concentrate, or if you've got a lower yield, you've got 379,000 herd margin. So you've got different herd margins. You could argue there could be some factors in terms of milk value, but to keep things simple, we've just kept the price the same, and of milk and the volume changing. So it's really to say, when we move on from one to the other, that's what we've got in terms of the money to play with on the farm, and to cater for the other costs below the line. So the next one, please. It's something that I think is a sort of a hidden gem, really, the Kingsay milk map. It's great to show where we fit, and it could be this year, last year on an individual herd, but it shows, the green line says that if we were to have the same level of concentrate but achieve a different yield, we can generate at those average organic values £1,462 more per cow if we were to move up the yield on the more efficient use of concentrate. And on the other hand, if on the purple line, if we had the same amount of yield and we could be more efficient and take from the Kingsay map more from forage and less concentrate input, we can probably save £1,450 worth of average concentrate cost. So there's a great scope, and wherever you fit on that map, if you're against the top line, it can be argued that you're doing pretty well to start with. So it's quite a challenge, but it does give you a bit of a plan. Where can you go? Where can you move to? So I find that's a really great place to start talking about where can we go and what does it mean in terms of potential for the farm. So the next one, please. So it's really, how do we drive these margins and have this herd margin over concentrate? Well, we've really got to concentrate on forage and quality and quantity, and that was something that last year we called causes issues, and milk dropped subsequently because of that. And beyond the value, the nutritional value of the forage we got, how do we maximise intakes and minimise losses so we get more into the cow? And that's all about complementing forage, and how do we drive forage intakes up and minimise what we need to put with it to come to a balanced diet. So that's the forage angle. The concentrate side, it's picking the best complementary ration to go with the forage, and so the components of that ration which are most suitable depending on what you've got as the bulk feed, and again really looking at that base ration forage analysis and looking at the whole mix or the forage on a regular basis. It is surprising how things do change and how things could benefit from perhaps changing diets as forages change. And I think the really big thing that you notice from farm to farm is the feeding environment, the facilities that the cows are afforded with, and how do we get dry matter intake into cows in terms of how we manage them, the facilities that they've got, and what are the limits. So where do we know where we are now in dry matter intake for forage, and do we know where we can go to, and what we need to do to manage those, and how do we measure dry matter intake, and what can we do to sort of stimulate more forage in that equation. So the next one, please. Just quickly moving, last two slides, really quickly moving from the herd margin to the net margin. The margin over concentrate, the net margin is, so we're looking at maximising the value of yield and optimising the balance of the feed. So trying to feed more forage, better feed efficiency, and for whatever our given yield targets are. We then look at the gross margin effect. So really, the replacement costs as well as the feed costs are really significant factors in how we end up with a healthy gross margin. And moving beyond gross margin to net margin is there are some costs that are more fixed than others. And I would always look at what are the relative value of the costs on your farm compared to what the set are. So for example, if you've got a high machinery cost, full stop, how is that split between contractors and own machinery? So if you've got a very high level of machinery depreciation and a high contract cost, it's are you doubling up on things you might not require? And also, let's be mindful all the way through of looking at the difference between cost and investment. And when you ask people about labour, for example, which we all know is very tricky on farm, there are some people that think labour is a cost, and there are some people that think labour is an investment. And I think those that think it's an investment are probably going to be more winning in their ways with their labour and their output and what they get out of that particular aspect. So looking at the different areas. The next one, please. Really the take-home points that I would sort of say is please undertake an annual business review, however that is formed, produce a budget. What's been achieved is a good start, and what you've got to achieve is where you are. And then from that point, look at the focus areas. Where are the big costs? So we know feed, fuel, power this year is things we might be able to do something about, we might not be able to do something about, but how can we influence the overall effect of those? Look at some stress testing in certain areas of what happens if these things happen or don't happen, what effect is that on the bottom line? And set budgets that you can actually manage. You're looking at the management of performance. So it's great to have a budget done in the kitchen, in the warmth of the kitchen with a spreadsheet and a laptop, but then you ignore what goes on in the farmyard. Is it really achievable with what you've got as facilities and cows and people? So manage that performance to achieve the financial goals that you need, and regularly review the budgets. And it's psychology. I've not wanted to look at my budgets the second half of this winter, as I know they've not been as good as I'd like them to be. So it is a thing to get in there and look at the hard facts. They might not be particularly good all the time, but it does help to get you to sort of ground zero and work out what we're going to do. And use an advisor on farm that understands the system from the grassroots upwards, so understands your farm, your business, and what really makes it tick. And back to this one, not just the numbers, not saying you just need another 25 cows at 1,500 quid margin and it will all be all right. It's what really makes it work out in the farmyard. And for those, I would say, engage with an organic specialist that really understands the system and what we need as organic farmers, because we are constrained in many respects with the standards, but we can do things that perhaps are a bit unthinkable sometimes. So make sure you know what to do. The next one, please. I think probably says the end. That's it. So thank you very much.
Thanks very much, Andy. Very insightful. We've had sort of several questions in, so if it's okay, I'll move on to try and get some of those answered and try and direct them in the right direction. So the first question, Andy, while it's fresh in our mind, we've been asked, is the retained a reference to a net profit? I think that was asked on your slide where you were looking at the amount, the sort of pence per litre that you were trying to retain.
Yes, so it's all to do with the net profit, and usually it starts off with pounds thousands. What have you got left in the trading accounts, and what are your obligations to use that on, and then where do you go from there?
Thank you. Hopefully that answers the question that was asked. If anybody wants any more detail on that, we're happy to pick up offline. One for you here, George. Been asked, what is India's export of organic feed going to be going forward? So I guess that's a reference to some of the scenarios around certification that we're.
Exports are from India are continuing in small amounts, but the Chinese market has been the competitive one recently. But as prices rise with the Chinese, India will come in more and more. I get the feeling that some people are happy to pay for a slightly higher protein Indian, slightly lower moisture meal than Chinese, and they're the people who are still buying it.
Thank you very much. Andy, another one for you here. So I think this is best answered by you. For clarification, we talked about does price-sensitive organic consumer, which was referred to earlier on, mean that 25% will not buy organic and are likely to drop down to non-organic product? So
I think there's always that risk, and I think George was right. Just that number is that relevant now as we hit these tough economic times? I think we go back to we talk about the dark greens and the light greens in the organic sector and the fully committed, and if you like, we've got to remember that organic is only 3.5% of the market, and I think we very much sort of talk above, it's our world, but it's 3.5% of the market, and I think people aspire to want to use organic, but I think that will be challenged around the fringes, and I think people want safe products, they want different products. I think sometimes the organic message can be simplified so that people can understand it more, but it is a risk whether we look at the 25%. Time will tell. Certainly 2009 showed us that when people were under financial pressure, they moved away from organic.
Thank you. George, another one for you to field here. Are there any new organic ingredients likely to come to the UK? Or is there any encouragement for UK growers to produce organic ingredients? So two parts of that one.
The first one is there's an awful lot of encouragement with it at the moment because prices are so high. However, getting supply chains certified and finding new commodities is very difficult. We are looking more and more at West Africa as they get their organic programs into line, and the shipping costs from West Africa are a lot less. It's a lot closer to the UK, and the commodities are slightly cheaper. But like I say, it hinges on them getting the organic production into line, and there will be maybe a few new commodities from there, but nothing of very high protein at the moment.
You mentioned yesterday in discussion, George, about the sustainability credentials of the West African sourced raw materials as well, being quite high.
We've seen from buyers that price is obviously the main objective, but more and more sustainability comes into it. And the beauty of West Africa is that it's a lot of old European colonies, which means they're friendly with information, put it like that, whereas other Asian origins might not be. And there's even doing business in West Africa ticks a lot of sustainability boxes for companies. You are giving people an extra income on the ground. We recently had a look at a commodity called organic shea, which is grown wild in Africa and is collected by African women, and exporting that to the UK will again tick sustainability boxes. It gives them another source of income. It hopefully gives them higher income. The deforestation in West Africa is a lot less. There aren't as many endangered rainforests. I don't think there are any endangered rainforests in West Africa. And plus, many of the plantations are run by NGOs as giving locals another source of income. So if we're buying organic palm kernel meal from there, it again ticks a lot of sustainability.
Thank you. Andy, back to you with this one. We've been asked, what's the most straightforward change most organic farmers can make to move themselves towards the top quartile for MOPF?
I think the biggest change is to challenge how we can get more forage into cows. We're still seeing quite potentially low levels of forage dry matter, and it does start off with how we line up the dry cows and how we do proper transition feeding of dry cows to stimulate what they can do in early lactation. So and if you think about it, we see a lot of people that regularly achieve 15 to 16 kilos of dry matter from forage, and we see other people that struggle to get above 12. And that 3 to 4 kilos of forage dry matter, in theory, has to be replaced either with concentrate, or it means that the yields are 2 to 3 litres lower than perhaps could be achieved. So dry matter intake is key from the forage perspective, and how do we set a cow up and feed it to maximise it. That would be my single goal, if you like.
Thank you very much. Not a question as such, but a bit of praise here, Andy. Somebody commenting that your advice is sound, whether organic or conventional. So moving on, another question for you, George. Somebody wants to know where we mainly look to source organic proteins from.
Organic proteins at the moment is China and India. However, it was switching a bit more to Eastern Europe and Ukraine and Russia, but that's been put back. Now the reason they were or one of the reasons the Indian origin and Chinese origin are competitive is they crush all the beans at source. But again, West Africa exports organic soybeans, so it might be another option in the future. But I think the more protein we can grow in the EU and the UK, the better. However, trying to grow anything over 24% is hard.
Do you see the EU directive or drive towards having 25% of the land in organic conversion or being farmed organically by 2030 as A, realistic, and B, having much impact?
A, no, but it's great to be ambitious. Good for them. Good to have a target. But it's a hell of a target as well. We shouldn't make light of it really, but their market is also growing a lot faster than ours. I think ours grows at 67% a year, something like that. Theirs is more like 13-14%, which is the need for that. and they've made it very clear that they want to grow more themselves, which I think maybe the UK could do better at. So that would be a positive from that. And what was the second part of it? Sorry.
Well, it's more whether we felt it would have much of an impact, but if we don't think it's very realistic, then that probably answers itself, George.
It will definitely have an impact, but again, the EU, UK, and growing protein is not easy.
Yeah. Question now on security of supply. Will there be enough supply of organic grain going forward, and should farmers be looking at on-farm alternatives? So I'll probably pick up the second part, but maybe you can answer the supply of organic grain.
Grain is offered freely in the market by, as I believe, most ex-farm traders, imported traders. The supply is as fragile as it's ever been, but new crops offered in decent volumes.
Very good. Yeah, so in answer to should farmers be looking at more on-farm alternatives, I mean, I think this year more than ever, people have been looking at maximising the value of homegrown crops and looking at alternative protein sources. So definitely opportunities there, and we should be maximising what we can produce ourselves on farm. Aside from grains, George, do you see any potential shortages? Any pinches in the supply chain?
Ukraine was the largest global exporter of sunflower seeds, which caused us a bit of concern at the start, but China's plugged the gap. And availability is a slightly different question. So supply chains, or the supply chain from China has increased from 2 months to 4 months. So if a farmer was looking to cover for the winter, your next shipment position out of China would be June. You might be waiting 4 months for that. So I'd just say that it is sometimes important to feed a supply chain. ForFarmers can't buy a load of commodities without a bit of farmer support, which means we can't buy anything. And when the supply chain's length increases, it pinches in a big way.
Which then leads on to the crystal ball gazing bit. So when's the right time to start looking to book winter requirements?
I might lose signal in a minute. I've always been a fan of little and often, and getting a good average. Harvest is never a bad time either, but if you've held off for 2 months, I would be having a serious look at doing something.
Okay, so yeah, time to start having some conversations then. I think we've got time for one final question. I have promised Cara that we would wrap up at 8 o'clock. If I don't get to your questions that have been asked, we've got a few still in the box. I'll come back to you individually. One for you, Andy. With the organic milk to feed price ratio being as far adrift of conventional as it is, can the organic sector continue to produce milk all year round, or will it be driven towards a more sort of spring calving crossbred system?
I think, of course, on the face of it, the spring calving crossbred block calving profile appears a cheaper system. But what usually catches up with you at some point is the seasonality value of that milk from the milk buyers. So it's not necessarily a case of do we want to produce more milk in the spring when, relatively speaking, there's a flat supply. Yes, there's a certain amount of spring milk goes into cheese production and can be looked at in that way, but relatively speaking, the demand for consumers is relatively flat. So what will happen, depending on the relative value, which is good at the moment, if of a non-organic use of that milk, but who knows where that's going to go. And we make the big assumption And we know there is a drift towards a higher cost of producing milk in the winter, but I think on a lot of farms that is a higher cost than it really needs to be. And I think if again we come back to forage and back to forage intakes, why do we see some farmers in the winter with a 9p a litre to 11p a litre cost set, and others on 15 to 16p a litre? And it's purely down to either, or probably the most important one is the forage quality, and it could be down to an aspirational need just to drive yield at any cost, which I think the milk price feed cost ratio is one thing it does tell you, is you don't get milk at any cost and any focus. So let's look at what is the sweet spot on the farm. There's got to be, in some cases, a better sweet spot on a lot of farms, I think.
Thank you very much, Andy. George, thank you very much for your participation and time. Much appreciated. Thank you, everybody, for your attendance. As I say, any questions that we failed to get to now, we'll pick up individually and try and get an answer to you. So with that, I'll wrap up and have a good evening.
Thanks again.
Thank you.